Top fund managers overseeing over $1.5 trillion in assets have urged the Bank of England (BO) to halt its active sales of UK government bonds, known as gilts, citing concerns that the policy is exacerbating market instability and increasing taxpayer costs. This call comes amid a backdrop of rising long-term borrowing costs and heightened volatility in the debt market. The UK bond market has experienced significant turbulence, with 30-year gilt yields reaching their highest levels in decades. This surge in yields has been attributed to a combination of factors, including global economic uncertainties, fiscal concerns, and the BO's ongoing quantitative tightening (QT) measures. Despite the BO's decision to reduce the pace of its bond sales from £100 billion to £70 billion annually, investors argue that this adjustment is insufficient to mitigate the adverse effects on the market. Impact on taxpayers and debt sustainability. The active sale of gilts has led to a crystallization of paper losses, resulting in an estimated £22 billion annual cost to taxpayers. Critics, including RBC Bluebay's Mark Dowding and BNY Newton's Paul Flood, warn that the current approach could create a damaging, fiscal feedback loop, where rising yields increase government borrowing costs, further straining public finances. They advocate for a full halt to active QT to prevent further destabilization of the debt markets. Calls for policy reversal. Former members of the BO's Monetary Policy Committee have also expressed concerns about the current policy direction. They suggest that the BO's aggressive bond selling program is distorting monetary policy and contributing to market instability. Some experts propose shifting towards a passive QT approach, where bonds are allowed to mature without being replaced, to alleviate pressure on the market and reduce taxpayer exposure to potential losses. The growing consensus among fund managers and financial experts is that the BO's current strategy of active gilt sales may be counterproductive, potentially leading to higher borrowing costs and increased fiscal strain. A reevaluation of the BO's approach to quantitative tightening, with consideration for a more passive strategy, could be essential to restoring stability to the UK's debt markets and safeguarding taxpayer interests.